We thought it was over. We thought the beast was slain. By the spring of 2025, the great inflation fight seemed won. The soft landing wasn't just a possibility, it was declared a reality. The Federal Reserve pivoted, rates came down, and the markets cheered. But as we close out 2025, the narrative has dramatically shifted. The data has turned against us, and the ghost of the 1970s has returned to haunt the American economy. The headlines today are grim. The late 2025 inflation resurgence has caught policymakers, investors, and consumers completely off guard. So, what happened? How did we go from victory lap to crisis management in less than 6 months? The answer isn't simple. It's a complex collision of premature policy easing, unexpected geopolitical shocks, and structural economic flaws we ignored. Today, we are conducting a post-mortem on the 2025 economic reversal. We're digging into the data to find out exactly what broke the trend. This is the definitive breakdown of the late 2025 inflation shock. Welcome to the deep dive. To understand the failure of late 2025, we must rewind to the stubborn reality of 2024. That year was defined by the last-mile problem. Getting inflation from 9% down to 3% was the easy part. Getting it from 3% to the Fed's magical 2% target proved agonizingly difficult. Throughout 2024, the Fed maintained a higher-for-longer stance. Interest rates were suffocating, designed to crush demand just enough without causing a depression. It was a painful period. The housing market froze, small business borrowing dried up, and the cracks in the labor market finally began to show. By late 2024, the medicine was working, perhaps too well. Unemployment ticked up past 4.5%, setting off alarm bells in Washington. The Fed faced intense political pressure. Their dual mandate, stable prices and maximum employment, was coming into direct conflict. As 2025 dawned, the data seemed to offer a golden off-ramp. The Personal Consumption Expenditures Index, the Fed's favorite measure, touched 2.1%. In March 2025, the pivotal moment arrived. The Federal Reserve announced its first rate cut in years, signaling the end of the tightening cycle. The Powell pivot ignited a massive risk-on rally. The S&P 500 hit new all-time highs, and bond yields collapsed as investors priced in a new era of easy money. The real economy felt the relief immediately. The 30-year mortgage rate, which had paralyzed housing, dropped significantly, thawing the market almost overnight. Consumer sentiment rebounded. The fear of recession was replaced by the fear of missing out on the recovery. Spending on durable goods picked up for the first time in 2 years. It felt like victory. But in hindsight, the Fed may have taken their foot off the brake just as the car was approaching a steep downhill grade. The summer of 2025 was characterized by an eerie calm. We call this period the Great Complacency. Inflation data for the summer months was benign. It wasn't hitting 2%, but it wasn't rising either. It seemed contained. The consensus on Wall Street was absolute. The Goldilocks scenario was here, not too hot, not too cold. The hard work was done. Markets priced in 3 more rate cuts before the end of the year. The assumption was that the trajectory was linearly downward. But beneath the placid surface data, inflationary embers were glowing hotter, fueled by the very rate cuts meant to save the economy. Financial conditions loosened faster than at almost any point in history. Capital became cheap again, and that capital needed somewhere to go. The wake-up call was rude, abrupt, and undeniable. It arrived with the September CPI print, released in early October. Expectations were for a mild 0.2% month-over-month increase. The actual number was a shocking 0.6%. Annualized inflation jumped back over 3.5% in a single bound. The trend line was broken. This wasn't statistical noise, it was a reversal. The financial media went into a frenzy. The narrative of the soft landing evaporated in minutes, replaced by panic about a second wave. When we opened the hood of that September report, we didn't just see one problem. We saw three distinct engines of inflation firing all at once. The first and most violent driver was energy. We ignored the geopolitical risks that had been building all year. In late August 2025, simmering tensions in key shipping lanes escalated into a partial blockade of critical oil transit routes. Oil markets panicked. West Texas Intermediate crude, which had been stable around $75, vaulted past $110 a barrel by late September. The impact at the pump was immediate. Gas prices surged nationwide, draining consumer wallets and increasing transportation costs for every good in the economy. Compounding the problem, the U.S. Strategic Petroleum Reserve was already depleted from older drawdowns, leaving the administration with few tools to cushion the blow. This wasn't just about gasoline. Skyrocketing diesel prices raised the cost of farming and logistics, ensuring the energy shock would bleed into food prices by year-end. If energy was the external shock, housing was the self-inflicted wound caused by the Fed's rate cuts. When mortgage rates dropped in the spring, millions of buyers who had been sidelined rushed back into the market simultaneously. The inventory of homes for sale was still historically low. The sudden surge in demand created fierce bidding wars in suburbs across the country. Home prices, which had flattened in 2024, began rising at a double-digit annualized pace again by the autumn of 2025. The crucial issue here is how housing is calculated in CPI. It's called owner's equivalent rent, and it operates with a significant lag. The spike in actual home prices in mid-2025 guaranteed that official housing inflation data would remain scorching hot well into 2026. The Fed reignited the stickiest part of the basket. The third driver was the realization that the labor market wasn't as cool as we thought, particularly in essential services. While the price of physical goods had stabilized, the service sector, which is labor-intensive, saw inflation reaccelerate. Late 2025 saw a renewed wave of labor actions. Unions, facing renewed cost-of-living pressures from energy and housing, demanded significantly higher wages. We began to see clear evidence of a wage price spiral in sectors like healthcare, education, and hospitality. Companies passed on higher labor costs immediately. Wage growth, which had been decelerating toward a sustainable 3.5%, ticked back up toward 5%. This is a level incompatible with a 2% inflation target. So you have an energy supply shock, a housing demand shock fueled by rate cuts, and a sticky wage floor in services. It was the perfect inflationary storm. By November 2025, the atmosphere inside the Federal Reserve was one of crisis. They had been spectacularly wrong. The guidance they provided to markets just months earlier, that rates were heading down, was now totally obsolete. Chair Powell faced the media with a brutal dilemma. To fight this new inflation, he would have to reverse course and hike rates again. But hiking rates into an energy shock is dangerous. It risks causing severe stagflation, crushing the economy without necessarily solving the supply-side energy issues. The political heat was immense. The administration felt betrayed by the pivot then reversal, and Congress demanded answers for the renewed cost-of-living crisis. The Fed's credibility, hard-won over the previous 3 years, was shattered. Forward guidance was no longer trusted by anyone. Financial markets reacted to the late 2025 realization with violence. The Goldilocks narrative died hard. The bond market suffered a historic rout. The 10-year Treasury yield, the benchmark for global finance, skyrocketed from below 4% to over 5.2% in weeks. This violent repricing of risk-free rates forced a massive devaluation of every other asset class. If you can get 5% from Uncle Sam, why hold risky tech stocks? The tech-heavy Nasdaq entered a swift bear market, erasing all the gains made during the euphoria of the early 2025 rate cuts. Corporate credit markets seized up. Companies that needed to refinance debt in late 2025 suddenly faced ruinously expensive borrowing costs. Volatility returned with a vengeance. The VIX index, the market's fear gauge, tripled as investors realized the Fed put was gone. But the real pain wasn't on Wall Street. It was on Main Street, where inflation fatigue turned into despair. By late 2025, the cumulative increase in prices since the start of the decade crossed 25%. The dollar in your pocket bought significantly less. Even workers who received raises felt they were falling behind. The psychological toll of constantly rising prices sapped consumer confidence to recessionary levels. The data showed the strain. Credit card balances hit all-time highs, and by late 2025, delinquency rates began to hockey stick upward. The consumer was tapped out. The bottom 50% of income earners were facing a genuine crisis of necessities, forced to choose between heating their homes due to the energy shock or buying food. The tragedy of late 2025 is that the brief hope of relief earlier in the year made the subsequent crash in purchasing power feel twice as painful. As the crisis deepened, the economic debate shifted. The word transitory made a comeback, but few believed it this time. The structural argument gained traction. We were in a new era of deglobalization. Bringing supply chains home, nearshoring, is inflationary, period. Demographics were another structural headwind. The boomer generation was retiring en masse, continuing to consume services while leaving the workforce, tightening the labor supply permanently. The transition to green energy, while necessary, proved expensive. The immense capital investment required for new infrastructure was inherently inflationary in the short to medium term. Many economists concluded that the 2% inflation target itself was a relic of a bygone era of cheap labor and cheap energy that wasn't coming back. The uncomfortable question arose: did the Fed need to accept a higher inflation baseline, say 3% or 4%, as the new normal? We cannot ignore the elephant in the room. The federal government continued to spend money like it was 2020. Throughout 2024 and 2025, even while the economy grew, the federal deficit remained dangerously high, pumping trillions of dollars of stimulus into the system. Massive spending bills from previous years were still deploying capital into the economy, competing for scarce labor and materials, driving up costs. Economists began warning of fiscal dominance, a situation where the Fed loses control of inflation because government spending overwhelms monetary policy. The Fed was stepping on the brakes while Congress was stepping on the gas. The result was the engine overheating in late 2025. The U.S. wasn't an island. Global factors played a critical and surprising role in the late 2025 shock. For years, China exported deflation to the world. But in late 2025, after massive internal stimulus, China's factory gate prices started rising again. The China price stopped falling. The U.S. began importing inflation again via goods from Asia, just as domestic service inflation was heating up. Meanwhile, Europe was facing a deeper recession and cut rates aggressively. This weakened the euro against the dollar. A hyper-strong dollar hurt U.S. manufacturers, creating a bifurcated economy, a struggling industrial sector versus and overheating services sector. By December 2025, the conversation shifted to the most dreaded economic scenario of all: stagflation. It's the toxic combination of slow economic growth, high unemployment, and rising prices, the worst of all worlds. The late 2025 data painted this exact picture. The energy shock and high rates were killing growth, yet prices continued to climb. The parallels to the 1970s became undeniable, a decade lost to stop-start monetary policy and external shocks. In a stagflationary environment, the Fed is paralyzed. Cutting rates boosts inflation, raising rates deepens the recession. There are no good options. As we look ahead to 2026, the range of possible outcomes is wider and more terrifying than it has been in decades. Scenario 1. The Fed accepts the pain. They hike rates aggressively, perhaps to 7% or 8%, forcing a deep recession to finally break the inflation psychology. Scenario 2. The Fed blinks due to political pressure or financial instability. They allow inflation to run hot, destroying the currency while the economy shrinks. Scenario 3. A prolonged period of mediocre growth and stubbornly high inflation, the muddle through that lasts for years, slowly eroding living standards. Right now, at the end of 2025, betting markets are split evenly on which path we take. The only certainty is volatility. For investors, the playbook that worked for the last 40 years of falling interest rates is officially dead. The traditional 60-40 stock and bond portfolio failed spectacularly in late 2025, as stocks and bonds fell together. In a new inflationary regime, capital fled to hard assets. Gold hit record highs as the ultimate hedge against central bank incompetence. Investors shifted from speculative growth stocks, whose future earnings were discounted by high rates, into companies with real cash flow today: energy, industrials, and staples. And for the first time in a generation, cash, specifically short-term government treasuries paying high yields, became a viable asset class to weather the storm. The inflation resurgence of late 2025 was a humbling reminder that the economy is not a machine you can fine-tune with a single dial. We learned that declaring victory too soon is dangerous, that geopolitical risks matter, and that the structural forces of the 21st century are inherently inflationary. As we enter 2026, America faces a difficult adjustment to a new economic reality. The era of easy money and stable prices is over. We will be here tracking every development of this unfolding crisis. This is history in the making, and your wallet is on the front line. If you found this deep dive valuable, please like and subscribe. It helps us keep producing this level of analysis. And let us know in the comments, do you think the Fed can regain control in 2026? Thanks for watching.